Hey folks, Dan Frio here, the rate update. Today is January 27th, 2021. Let's get at it. There's a lot of news to go over today, and I'm not even going to show my intro video here. I'm just going to jump right into it. The biggest piece of the puzzle for the economy right now is the Fed and what they're doing and the stimulus. Okay, those are the most integral part of the markets right now. It doesn't matter if you're talking stocks, bonds, crypto, real estate, anything. That is the biggest or the most incentivized thing in the markets, and that's really pushing the markets higher and higher and higher. Apple just came out with blowout quarters. All the earnings that came out today, basically all the ones that we follow, and if you follow my Scrub video in the mornings, Scrub is stocks, crypto, real estate, and bonds. I go over what's going on in the bond, all those markets, bonds, cryptos, real estate, and stocks. I tell you what the morning looks like, what the afternoons are going to look like, what earnings seasons are, what crypto's doing, and all that stuff. And we were basically on the edge of our seats today. Just what's the Fed going to say? Or let me rephrase that, how they're going to say it. So let's go over and go through exactly what the Fed said, and then I'll give you my feedback, and then I'll show you what the markets did in response to that. So the biggest thing here is, what did the Fed say? They basically said the same thing they said before, which we loved. They made a couple revisions, but those revisions are seamless. And the biggest news that we were looking at is basically, here's what they're saying. Is COVID pandemic is causing tremendous human and economic hardship across the United States and around the world. And it said economic activity and employment. That was the previous one. Now they're saying the pace of the recovery in economic activity and employment has moderated in recent months, with weaknesses concentrated in the sectors most adversely affected by the pandemic. And this said previously have continued to recover but remain well below their levels at the beginning of the year. So really nothing there, nothing that somebody can look into and say, there's a sign that they're telling us. The next thing is you come down through here and it says, basically they added including progress with the vaccinations, which they expect the economy to start recovering at the end of the year because of this. The ongoing public health crisis, it says, will continue, and it says continues. So that's the same verbiage, just different wording to weigh on the economic activity. Employment inflation in the near term, they took out that and considered risk to the economic outlook. And that was about it. So what I'm going to show you here is a brief clipping of what the Federal Reserve Chairman Powell said. It's actually it's about a 6-minute clip to 6 to 8 minute clip. You can see what he's saying. The reason why I want to educate you guys on this is kind of a couple reasons. Is if you're a realtor, you're a mortgage person, you're a stockbroker, you're in real estate, you're in the stock market, you're in cryptocurrencies, you're in bonds. This is the biggest piece of the puzzle with all this stuff. You need to focus in on what he's saying. This is probably a great video to show your economics class and or other classes in college. Who needs basket weaving 101? We need to know what the economy's doing, what the Fed does. What does the Fed do? What do they control? Just so you guys know, they don't control mortgage rates. They control the federal funds rates, and I have videos in my channel that explain that. But right now we're going to go over what the federal chairman Powell said. If you want to skip through this to me coming back to where mortgage rates are, just skip through that portion of it, but I highly suggest you listen.
Achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we have taken forceful actions to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the FOMC and I kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy continues to depend significantly on the course of the virus. A resurgence in recent months in COVID-19 cases, hospitalizations, and deaths is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, the pace of the recovery has moderated in recent months, with the weakness concentrated in the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing. Household spending on services remains low, especially in sectors that typically require people to gather closely, including travel and hospitality. And household spending on goods has moderated, following earlier large gains. In contrast, the housing sector has more than fully recovered from the downturn, supported in part by low mortgage interest rates. Business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to federal stimulus payments and expanded unemployment benefits, which have provided essential support to many families and individuals. The recently enacted Coronavirus Response and Relief Act will provide additional support. Overall, economic activity remains below its level before the pandemic, and the path ahead remains highly uncertain. As with overall economic activity, the pace of improvement in the labor market has slowed in recent months. Employment fell by 140,000 in December, as continued gains in many industries were outweighed by significant losses in industries where the resurgence of the virus has weighed further on activity. In particular, the leisure and hospitality sector lost nearly 500,000 jobs, largely from restaurants and bars. The unemployment rate remained elevated at 6.7% in December, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices picked up over the summer, but have leveled out more recently. For those sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. While we should not underestimate the challenges we currently face, several developments point to an improved outlook for later this year. Sufficiently widespread vaccinations would enable us to put the pandemic behind us and return to more normal economic activities. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible. Support from fiscal policy will help households and businesses weather the downturn, as well as limit lasting damage to the economy that could otherwise impede the recovery. In addition, as we have seen since last summer, the economy has proved more resilient than expected, in part reflecting the adaptability of households and businesses. Finally, monetary policy is playing a key role in supporting the recovery and will continue to do so. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Today, we unanimously reaffirmed our statement on longer-run goals and monetary policy strategy, as we typically do each January. As we say in that statement, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since last March has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Our forward guidance for the federal funds rate, along with our balance sheet guidance, will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and ties the path of the federal funds rate and the balance sheet to progress toward reaching our employment and inflation goals. Thus, if progress toward our goals were to slow, the guidance would convey our intention to increase policy accommodation through a lower expected path of the federal funds rate and a higher expected path of the balance sheet. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. We've also taken actions to more directly support the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to your questions.
So did you hear what he said? He basically said the economy is it's struggling. Main sections are struggling. Some are doing very well. Some are doing absolutely terrible. The cloud business is doing well. Working from home, those stocks are doing very, very well. What's doing terribly? Travel and leisure. Boeing came out with earnings that, they were terrible. Hotels are going to come out. They're terrible. Restaurant chains are going to come out. They're terrible. I'm not buying them in my own portfolios because I don't think the timing's right. And this might be the bottom, but I'm not ready to risk that yet. So let's get on to what mortgage rates did today on the news from the Fed. Now I scrambled around here about 2:00 and we locked almost everything we had. Here's why. If you watch me on a consistent basis, we follow this number here and we follow this chart. Okay, what is this number? This basically is a number that's representative of what's happening with mortgage-backed securities, the price of a mortgage-backed security bond. This bond is representative of the biggest piece of the mortgage puzzle. So the yield on this bond is one of the biggest pieces of the mortgage rates. Those coupled on top of what we call loan level price adjustments, what are factors in for what kind of property you have. Is it an investment property? Is it your primary home? Is it a single family? Is it a condo? Is it a PUD? Is it a 2-unit, a 4-unit? What's your credit score? What's your loan to value? There's a whole slew of things that go into what makes up your mortgage rate. But this is one of the biggest pieces of that puzzle. Okay, so we chart this. The good news in what you just heard Federal Chairman Powell say is he came in and said they're going to continue to buy and stimulate the economy. Bonds and treasuries, they're going to add $80 billion a month to their portfolio, meaning they're going to buy $80 billion a month in bonds and treasuries. They're going to continue to buy $40 billion a month in mortgage-backed securities. That's what we wanted to hear. And it was right on target with what we expected. So let me get on to what I was talking about during this time frame. Okay, the Federal Reserve came in back last year, and let's go back to a year chart. And when the world almost came to an end, and they're like, oh my God, we got this pandemic, or we got this virus that's coming in, and it could it's catastrophic to the world, not just our economy. And then all of a sudden, then we recovered. Okay. Then the Federal Reserve came in and said, we can't have this. We can't have all this volatility in the market. So what are we going to do? We're going to come in and we're going to start buying up bonds, especially mortgage-backed securities, to stabilize the markets. And even the municipal bond market, the corporate bond market, all bond markets were struggling. Okay. So what they did is they came in and they started buying mortgage-backed securities, okay, to stabilize the market. So look at, if you take this chart and you say, okay, where should we be trading? Basically, you split it in half and it's right there, okay? But let's condense that even more. You condense it even more, and where's my line take us? Well, my line takes us right to there, all right? And there's a reason why I'm saying this. Look right here, and then look at these numbers, or these charts right here, these candlesticks. Okay, I'm going to go over this with you guys. And again, if you're in the real estate business, if you're a stockbroker, a wealth planner, a financial planner, an accountant, if you're a teacher, you might want to show your economics class this, because it's great information for everybody, honestly. And this might bore you to death. I have a passion with this stuff. Hopefully it extrudes through to you guys. But I love what I do and I love this stuff. So I'd love to help you if I can. And then you have these lines here. Okay, so I'm going to go through all this stuff with you in a quick little bond market update, or a charting update. Okay, all these lines going directly across, these are what we call Fibonacci levels. They're actually resistance levels going up and down. Okay, then you have a couple more numbers in here. Let me get rid of this. We have a couple more numbers: the purple, the black, and the brown. All right, let's move that over here. You can follow that. Okay, these are Fibonacci levels, where these create an upside and a downside resistance. So you should trade in normal ranges in between these Fibonacci levels, and then once you break one of these, the next resistant level is down here and then down here for the Fibonacci levels. Then we also have 25-day, 50-day, and 100-day moving averages. That's the purple line, the black line, and the brown line, respectively. Okay. The Federal Reserve, like I said, I put this line out back when I showed you the whole year's thing, saying they're trying to stabilize the market. And long term, that's where they're trying to be. So if you look at this line, there's no coincidence that we hit here. My projection, or my prediction, where this 50-day and 25-day moving average crossed, that's where I thought our resistance, or where we should be trading in a normal market, or where the Fed wants us to be trading. We're there. This might be 0.1 off. Okay, so when we were hitting this resistance level, by all means, go back and watch my videos. And I said, when we kept hitting this 3 days in a row, you can notice we hit it 2 days in a row and then we ease back. When we hit 3 days in a row, and I'm like, we got some problems here. And we started pulling back. And I said, well, don't worry, because we got a resistance line here, then here, then here, then here. We fell off the map. Well, I didn't freak out, because I'm like, okay, people overreacted. People overreacted like they normally do. So I said, when we were down here, I'm like, I'm not freaking out, locking anybody, because we should be trading in this range here. Patience is a virtue. Where did we go from there? And please go back to my videos, because I don't want to be one of those where it's like, oh, I predicted 15 years ago the stock market was going to crash, and it crashed. See, I told you so. Well, a clock's right twice every day. So, but I try to my darndest. And if I'm wrong, I'd be more than happy to come out and say, I blew that one. This one I nailed. I said, we should recover back to this range here. And where are we today? We're at that range there, right there on the button. And that's where I think we will be. And the Federal Reserve came in today with their information, as you just saw and read, and everything is right on target on what I expected. So that's what's going on there. But let's look at today's chart, because we ended the day, if you can see right here, up 5. Here's why and when I started locking everybody. Let's look at the day's chart. Okay, we started here. We went up, 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 but we crashed. And for some reason, this isn't coming out. Hold on. Let me see. My charts are not coming in. They aren't going, but you can see down here, there's dots. So I hope you can see that. We struggled up, and then right around 1 o'clock when the federal news came out, we crumbled back down. I had everybody on their seats at 1 o'clock logged in. As soon as we were up about 20 right here, as soon as I noticed we went from 20 down to about 8, we were down 14 at one point. I said, lock them. And we locked almost everybody we have, and we timed that one right on the button. So if you have a loan with us, you're probably going to get redisclosures saying your loan is locked, and I think we nailed this one. Economic calendar for today. The biggest news today was the Federal Reserve. Durable goods orders, they were bad, which we expected. But Federal Chairman Powell came in and gave his information, as you just saw, in regards to what the Federal Reserve is doing. Let's see what else. Here's what the Fed said. We already went through that. Here's the changes in their verbiage. We already went through that. So what do I expect for the remainder of the week and the rest of this month and going into probably the next few weeks? Really not much anything. But let's go into where rates are right now. And we're going to probably see these flat tomorrow. Because when we started the day, we started good. So we ended the day up five basis points. At one point, we were up 20. And I just showed you throughout the day how those moves affected everything. So when you look at what happened for the day, nothing really happened today. Actually, rates went up 1 basis point. If you're working with me, you actually probably got 0.1 or 0.2 lower rate than we thought you were going to get. Okay, so here's my 30-year terms. And guys, if you want a 15-year term or a 20-year term or a 10-year term or whatever, just email me. I'll give you all that information at the end. But if I were to go through all the scenarios in regards to each rate, we'd be here all day. And I already have people saying, Dan, speed it up a little bit, buddy. So I'm trying to do that. So today on the 30-year conforming jumbo FHA and VA, we're at 2.82. This is the national average. Now, some rates are lower, some rates are higher. It depends on what lender you go through. Hopefully you go through me, because mine are pretty much right in line with the national averages, just a little bit lower. But what we don't do is we don't gouge you in fees. So that's why a lot of people use us. Plus, we do all of this stuff for you. And I have videos that just came out. We help you with down payment assistance programs. We'll help you with your credit scores. We'll help you with a lot of stuff that nobody else is willing to do. But we'll go through this. Rate today, 2.82 on the conforming, 292 jumbo, 282 FHA, 244 VA. The one-day delta is 1 basis point. What 1 basis point is that's 1/100th of a percent. So that means yesterday, if the rates are up 1 basis point, that means yesterday's rate was 2.81. Because we added the other 1.1 over here, so now we're at 2.82. 7-day delta, which means a 7-day change, is conventional rates went down 3, and everything else pretty much stayed stagnant. So that explains this. It still shows you where rates were last year. We were in the high 3s, basically from 3, probably 7.5 to 3.99. And now you're in this range. So you're virtually about 1% lower than where we were last year. So that being said, you're like, now Dan, how do I get a hold of you? So, and who should reach out to me? Okay, so if you're in the market, you're buying a house, building a house, refinancing, please reach out to us. And I'm going to give you my email address as well as my website. Plus, I'm going to show you how to get my app online. I'm going to try to do that. I don't know if I can do this in this video, but I'll try to put a barcode down below in the description. You can just take a picture of it and it'll pop up my phone app, mobile app. It's crazy awesome. Just to let you guys know, you can follow your loan through every step of the mortgage process. You can do virtually everything you need to do on your phone. So the best way to reach me, or who needs to reach me if you're doing all of that. If you don't have a mortgage quote, love to hear from you. Send me your mortgage statement. Email me your scenario. Click in here, apply online, get a quick quote. Then one of my teammates will call you and go over, your scenario. Then they'll bring that scenario to me and I'll work up a game plan. And then myself and our mortgage advisors will call you back. That's the best way to do it. If you're in the process right now, you would have received what's called a loan estimate or a fee worksheet or a fee calculation. Email that to me. Get a second opinion. What's the worst thing you have to lose? You took 2 minutes to drag and drop your loan estimate to me, and I responded back saying, you got a great deal. Most of the time, probably 99% of the time, I'm going to get you a lower rate and lower fees. So how do you do this? How do you reach out to us? You go to therateupdate.com. This is the website. You scroll down. Here's my information, my address, all our social media. Phone number, it's an 800 number. You don't even have to waste money on that. 844-775-LOAN. 844-775-5626. Or email me. My name is Dan Frio. So my email address is dfrio@preferredrate.com. If you're looking to buy a house and you haven't started yet, this will walk you through some questions. Fantastic. The answers to the questions you give will help me structure your loan into the perfect program. That's to purchase, that's to refinance. If you're like, I just need to get the ball rolling because I got to get something done here. So you can click the Apply Now button. Everything's 100% secure. You'll go through that, fill out your application. At the end of your application, based on the answers you've given, it'll say, we need this from you. And it'll probably be like pay stubs, your W-2s, maybe a bank statement, and so forth. Again, guys, this is all secure. You can drag and drop it right into your file in there. If you want somebody to call you, just click here, get a free quote. Somebody will be on the phone with you probably within 15, 20 minutes. They better be. To answer any questions you got. If you're looking to get a home valuation on your home, you use Zillow, Redfin, Trulia, all these systems. You can go in there and put in your address, and it's going to give you all kind of bizarre numbers. This is the #1 home evaluation system in the country. It's a paid service. I cover the costs. I don't sell your data. I just use it for me and you to help each other get yourself financially fit with your mortgage. Okay? So that's basically all the criteria there. So that is it for today. Guys, I'm flying to sunny Florida tonight. I will be posting maybe tomorrow, but I promise you I'll be posting. I'll be back on Friday with some posts. Hopefully I'll be on the beach. And but if you need me for anything, I'm always here. And my loan advisors and mortgage advisors, I'm in touch with them all day, every day. So that's it for now. God bless. Have a great day, and I'll talk to you soon. Bye-bye.